Top news, it's the Russian dude. Let's immediately talk about some concerning signs why the stock market in the near future might drop all the way up to 23%, and the Federal Reserve now allowing the possibility to start increasing the rates by the end of this year, exactly the opposite what the market is hoping for. And to understand better the whole problem, we just have to talk about a massive concentration of the wealth inside just a few companies within the S&P 500 index. Specifically Nvidia, which on June 18th became the biggest, the most expensive company in the world temporarily, then it was always being constantly replaced by Microsoft back and forth, but it did happen. The price to sales ratio reached all the way to 36, which is the biggest number since 2000s. And guys, we already know what happened in the changing of the millennium. .com crash bubble. And just in general right now the stock market is expensive, but the worst thing about this particular time we're having right now is that once again a lot of wealth, a lot of market capitalization is concentrated in just a very few number of companies. And while the rest, 95% of the S&P 500 companies, they might already start to decline, they might lose their share prices value. The only reason why we still see the index going up, it is because of these companies which always beat the expectations, which always find a way to make more money, but most importantly, they continue to make extremely optimistic prognosis for the future. And this just variable prognosis, this is what keeps the S&P 500 going up. Here, for example, just to let you visualize how big Nvidia is, only 6 countries in the world, they have bigger GDP than the market capitalization of Nvidia. And just in the last 3 months alone, the market capitalization of Nvidia increased by $1.4 trillion. And at the moment of recording this video, just 3 companies, Nvidia, Microsoft and Apple, they represent 21.1% of the S&P 500 index. Yes, just 3 companies out of 500. And according to Ray Dalio, one of the biggest mistakes that investors are doing right now, specifically the ones which only recently entered the stock market, they think that this rally can continue forever. They think that the stock market fully recovered from all the problems it had in the past, and now the only possible way is up. There's not going to be any more recessions, corrections, because everything is good. Why would we turn into a negative zone? The share prices of companies right now are primarily going up because they are going up. The regular investors, once again, especially the new ones, they see that the share prices go up of the companies they want to buy, they start experiencing FOMO, fear of missing out, and they're like, well, it just goes up, goes up, goes up. I want to also participate in this growth, so they start buying these companies once every month or so, and then inevitably the decline begins, as it always happens. You already know, guys, what I'm talking about. Whenever you invest in a company, within a week or less, it starts to go down. I personally checked it, I personally proved it. And just because of this big greed and FOMO and the mindset that the stock market will never collapse, at least in the near future, this is one of the worst signs that you can see on the stock market, because whenever anyone is investing, whenever everyone is an expert, whenever everyone suggests a company, hey, you buy this, it's gonna 10x, and then indeed it can do it, because this is what happens during bull markets. Once again, this is one of the worst times on the market to invest, because be fearful when others are greedy, and be greedy when others are fearful. And as always, markets need a signal, usually obviously a bad one, to start a correction or even bigger decline. And this time it can be in a form that the Federal Reserve once again announced that maybe, in worst case scenario, but there is a possibility, that we might start increasing the interest rates by the end of the year. Completely the opposite what the rest of investors expect them to do. Because let's be honest, it is no longer a secret that the inflation is way stickier than people that the Federal Reserve anticipated. We can see that it is not budging that much anymore, while the interest rates, they still remain way higher than they should be. That's why, according to Neil Kashkari, at current trends, at current rates, the fight against inflation might take additional 1 to 2 years before it can reach the target of 2%. But still, as you can see from this graph, approximately 84% of smart money, they do think that the Federal Reserve will decrease the interest rates by the end of this year, which is once again exactly what I was telling you, that people right now in their majority expect that the Federal Reserve will cut the rates, which means that increasing the rates is completely the opposite from market expectation. This can be this extremely bad sign we're all waiting for. And according to the head of St. Louis Federal Reserve, Alberto Muslim, in case they do not see the inflation going to its target of 2% in the very near future, he will propose some very hawkish monetary policies, which is basically a nice way of saying we will start increasing the rates once again. He also sees the progress in fight against inflation. It slowed down significantly recently. It's not like that the inflation is barely budging. It is almost completely stalled at this point. For this reason, once again, only confirming the fact that they might increase the interest rates in the near future, in addition to the labor market, which is right now increasing once again. I mean, yes, thankfully more people get jobs and things like this, unemployment goes down a little bit, but because the employment market gets overheated, speaking in these guys' terms, because of this it also contributes to the inflation. Well, all the signs point that we might see interest rate hikes in the near future, or at least they will not be decreased by the end of the year like 84% of people think. And keep in mind, I'm not even highlighting the problem with the US national debt right here, which according to some estimations, very conservative ones, can reach $56 trillion within the next 10 years. This is another massive problem. As a result of all this, some very first analysts and experts from financial institutions, for example from JP Morgan, they start predicting correction or even a little bit a bigger decline at the stock market, which can happen in the near future and reach all the way to 23%. The guy I'm talking about is Marko Kalanovich, once again from JP Morgan, and he pretty much summarizes everything I just mentioned: the inflation, the unemployment, the labor market, the national debt of the US. So basically all these factors, or at least some individual of them, or even in the worst case scenario another black swan event, this is what can trigger the correction in the stock market, which, guys, as you already can see, is literally fueled by just a very few number of companies. As soon as this top 1% or even less, as soon as these 5 or magnificent 7 companies start declining, they will inevitably and very fast drag the rest of the S&P 500 index with them. Well, there I have it, guys. Thank you so much for watching. Please like this video, subscribe to my channel if this was interesting, informative for both, and see you tomorrow.